Some people spend years grinding to build their wealth. They save every dime, they invest consistently, and they watch their portfolio slowly grow. They believe that building wealth is a simple, linear process. You save 10,000, you are 10,000 richer, but then they hit a massive psychological wall they never saw coming. They stall out, not because they stop earning or the market turns against them, but because they hit a specific dollar amount that acts like a ruthless trap. That amount is $250,000. And I guarantee you, this is the most dangerous milestone in your entire financial journey. It's the point where having just enough money makes you incredibly dangerous to yourself. Today, we are diving deep into what I call the $250,000 rule. We will expose the 3 psychological traps that wipe out decades of careful progress. And most importantly, I'm going to give you 3 simple rules to successfully navigate this treacherous phase. Most people believe they fail financially because they don't earn enough, but that's dead wrong. Recent data shows the average American will earn well over $2 million in their working life. $2 million. Yet, somehow, most people retire with less than $100,000 in savings. Where does all that money go? It's not just reckless spending. It's about psychological traps that kick in at specific wealth levels. And the reason $250,000 is so critical is that it's the threshold where your money stops feeling theoretical and starts feeling real. This is when your invested capital begins moving faster than you do. One good market day can earn you more than your entire weekly paycheck. One exceptional month can generate significant passive growth. The scale has changed, and so must your mind. The transition from accumulator to protector is mentally jarring. Your entire identity shifts from someone who saves $500 a month to someone whose portfolio dictates their daily mood. The simple act of checking your account becomes an emotional roller coaster. This emotional volatility is precisely why most people are unprepared for this milestone. They mistakenly believe that financial growth requires increasing sophistication, when in reality, it demands increasing emotional stability. You must learn to treat your portfolio as a thriving factory, not a daily video game score. But here is where the danger lies. When you only had $5,000 invested, a 10% loss meant losing $500. It stings, sure, but it's not life-altering. When you have $250,000 invested, that same 10% loss costs you $25,000. That is the entire annual savings of the median American household. Suddenly, the stakes aren't just higher. They're in a completely different universe. And the first monster lurking here is the illusion of arrival. Trap 1. The illusion of arrival. You've finally reached $250,000 in investments. You check your portfolio on a Tuesday morning and boom, you are up $8,000 from the day before. Your brain immediately starts playing tricks on you. $8,000 in one day. That's more than you used to make in a month at your first job. Clearly, you've made it. You start feeling wealthy. You start telling yourself that you deserve to celebrate. Maybe it's time to upgrade the car. Perhaps that $10,000 vacation you put off is finally justifiable. You're practically rich now, right? Wrong. Dead wrong. The $8,000 gain is unrealized. It only exists on paper. It can disappear tomorrow just as quickly as it appeared. But that $10,000 vacation you took is very real, very permanent, and very capable of setting your financial journey back by months or even years. This is the dangerous illusion, the feeling of wealth before you are actually wealthy. It destroys more financial futures than market crashes and economic recessions combined. It's the moment your discipline breaks and lifestyle creep kicks in with a vengeance. This feeling of, "I've made it," is the quietest killer of long-term wealth. You start justifying small, unnecessary expenses that, when compounded, become catastrophic. That expensive coffee habit, the slightly bigger house you needed, the least luxury car, none of these seem reckless individually. But when discipline erodes, it opens the door to larger, more permanent debt burdens. The illusion of arrival tricks you into thinking your current net worth is sufficient for a future lifestyle, completely ignoring the decades of compounding required to achieve true financial independence. The moment you start acting rich is the moment you stop getting rich. You confuse momentum with arrival. This psychological slip sets you back not just the amount spent, but the future growth those dollars would have generated. This trap preys on your desire for immediate social status and validation. Trap 2. The overconfidence monster. But wait, it gets worse. Once you hit $250,000, not only do you feel rich, but you also become overconfident. This is fueled by a psychological phenomenon called the Dunning-Kruger effect. You manage to accumulate this money through consistent saving and investing in boring index funds. You've weathered a few market downturns and come out ahead. You start thinking you understand how the system works. You start believing you're some kind of investing genius. This is when people go completely off the rails. This is when the conservative index fund investor suddenly believes they can pick individual stocks. This is when they start dabbling in options trading or throwing large sums of money at speculative crypto. This is when the phrase, "I can afford to lose this," becomes the single most expensive sentence in the English language. The cruel irony is that at $250,000, you finally have enough money to make the kind of mistakes that can delete years of growth. You can afford to lose $20,000 on a bad pick. The problem is that affording to lose money and being able to afford losing money are two completely different things. A single $10,000 mistake today translates to roughly $40,000 in future wealth lost over 20 years due to the lack of compounding. This is the compound cost of poor decisions. You are wiping out years of diligent saving simply because you thought you were smarter than the market. This monster feeds on your ego, and it will sabotage your momentum faster than anything else. The overconfidence monster is fueled by short-term wins and misinformation. You see a lucky friend win big on a volatile stock and think, "I'm smart enough to replicate that." The core mistake is switching from playing a game of probability, consistent indexing, to playing a game of chance, speculation. This shift often happens just when the power of compounding is ready to accelerate your growth. Imagine standing next to a fully fueled rocket, and instead of allowing it to launch, you start tinkering with the engine based on a YouTube tutorial. You trade guaranteed exponential growth for risky, linear potential. Humility is the only shield against the Dunning-Kruger effect in finance. True financial intelligence is knowing what you don't know and sticking to systems that eliminate ego from the equation. Losing $20,000 on a speculative bet feels like a setback, but mathematically, it's a disaster that costs you a quarter of a century of momentum. Trap 3. The comparison trap. The final killer, lurking at the $250,000 mark, is the comparison trap. You finally reach $250,000 and feel successful for about 5 minutes. Then you go online, you meet someone at a networking event, or you stumble across a social media post. They mention they have $500,000 invested, or maybe $2 million. Suddenly, your $250,000 doesn't feel impressive anymore. You feel behind. You feel like a failure. This triggers what I call acceleration anxiety. You abandon your conservative, steady approach. You increase your risk tolerance beyond rational limits, making desperate moves to close the gap between where you are and where you think you should be. This is when people start leveraging their portfolios. They take out home equity loans to invest in the stock market. They convince themselves that taking on debt to invest is just being strategic. If the market returns 10% and you can borrow at 6%, that's free money, right? Wrong. That's how you turn a temporary setback into a permanent catastrophe. The comparison trap is vicious because it never ends. There will always be someone with more money than you. Always. The moment you start measuring your success against someone else's highlight reel is the moment you stop appreciating how far you've actually come. At $250,000, you have just enough money to make really stupid decisions in the name of catching up. It is the most dangerous inflection point in the entire wealth-building journey. The comparison trap is far worse today than it was 20 years ago because of the constant stream of curated success stories online. You are no longer just comparing yourself to the neighbor with a slightly nicer car. You are comparing your $250,000 to a stranger's heavily filtered multi-million-dollar portfolio. This digital keeping up with the Joneses creates unbearable pressure. This is the stage where people make the fatal leap into leveraging, using borrowed money to increase market exposure. They rationalize that debt is a tool, not a liability, when used for investing. But when market volatility meets leverage, even a small downturn can wipe out your hard-earned principal, forcing you to sell everything at a loss. They prioritize social perception over financial reality. They sabotage their own future chasing someone else's highlight reel, forgetting that the real goal is control over time, not control over Instagram followers. The solution: 3 rules to win. So, how do you navigate this treacherous threshold? The secret isn't learning new complex strategies. It is unlearning the need to be clever. The biggest winners at this level are often the most boring people you'd never want to sit next to at a dinner party. They keep buying the same index funds. They keep living in the same reasonable house. They keep doing the same boring things that got them here in the first place. Here are the 3 rules to defeat the $250,000 traps. Rule has shown: stay boring and embrace the momentum. You do not need to get fancy. You do not need to pick stocks. You need to keep doing exactly what worked. Continuing to do the boring thing feels like you are leaving money on the table, but it is the critical choice. Discipline is more valuable than intelligence at this stage. Staying boring requires active resistance against your own biology. Your brain craves novelty and excitement. Watching your investment account slowly rise feels dull compared to the thrill of a speculative pick. You must actively fight the urge to optimize or get cute. Financial independence is won in the quiet consistency of dollar-cost averaging, not in frantic trading. The discipline you learned saving those first few $1,000s is the exact same discipline required to manage $250,000 and eventually $1 million. The challenge intensifies because the stakes are higher, but the solution remains the same: automate your process and ignore the noise. Boring is the foundation of exponential wealth. Rule #2. Understand the math of escape velocity. $250,000 is not a quarter of the way to $1 million. It is actually halfway to becoming a millionaire, measured in time. Think about this. If you are consistently investing, the time it takes to get from $250,000 to $500,000 is about half the time it took you to get from $0 to $250,000. The growth snowballs. Your money has achieved escape velocity. The second $250,000 comes twice as fast as the first. The growth is inevitable, provided you don't interfere. The moment you hit $250,000, your money shifts from being primarily powered by your contributions to being primarily powered by returns. Before this point, saving was the engine. After this point, the market returns are the engine. This is why the time advantage is so crucial. If you took 15 years to get from $0 to $250,000, compounding suggests you can reach $500,000 in only about 7 to 8 more years, assuming steady returns and contributions. This exponential leap is the reward for your decade plus of discipline. Don't interrupt the momentum right when the flywheel starts spinning fastest. Protect the asset, and the asset will inevitably multiply itself. Understanding this math is the psychological antidote to acceleration anxiety. Rule #3. Your only job is not to screw it up. Your primary focus is not acceleration. It is protection. The worst thing you can do at this point is interfere with the money's momentum by getting creative or reckless. Every dollar you lose now costs you roughly $4 in future wealth. The $250,000 milestone is not about the money itself. It's about the freedom that money provides, the freedom to make career decisions based on opportunity, not desperation. It gives you options. It gives you control. Don't trade that genuine, powerful control for an illusion of wealth or the short-term thrill of a high-risk gamble. Stay disciplined, stay consistent, and let compounding do what it does best. The hardest part wasn't getting to $250,000. The hardest part is not destroying it on your way to becoming a millionaire. The protection phase is the most valuable use of your energy. Protecting your $250,000 means you have gained significant leverage in your life that no expensive mistake should risk. It gives you the option to walk away from a toxic job, negotiate a better salary, or take a sabbatical to pursue a passion project. The true power of $250,000 is not what it can buy, but what it allows you to say no to. Don't exchange this priceless, defensive freedom for the offensive gamble of trying to get rich faster. Your job is to be the protective moat around the fortress of your wealth. By avoiding reckless interference, you ensure that the wealth-building process moves from being a struggle to an inevitability. Your future self will thank you for the quiet, boring commitment you make today. If you have hit this milestone, or if you are on your way, let me know in the comments. Which of these 3 psychological traps are you struggling with the most right now? Your experience might help someone else stay on the right path. Thank you for watching.